Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 29th of 2026. We get started this week. I think it's healthy to take a look back over many years and look at investment performance as we're sitting here with at least a couple of our main equity indices now in official correction, which just simply means that they're 10% off of their peaks. And as we know that some of these indices have been performing quite well. But you always take stock when you hit a correction in any of the investment markets. And I think, again, it's really important to sit back and look at history because history is a guide. It's not an absolute, but here's a chart that goes back to 1949. You can see the blue represents expansions, red represents contractions of some measure, and you can see some of those contractions are relatively meaningful, but generally speaking, the markets go up a lot more than they go down. And so since 1949 here, the average S&P 500 bull market lasted about 5.3 years, and that total gain achieved during that time frame was 254%. And it's been in a bear market on average only 1 year, and the decline in those bear markets has been on average about 31%. So this is representative of kind of like normal volatility over time. We do know that markets tend to have a few 5% downturns in a year. And that's obviously, as you can see here in the blue, that's typically offset by gains of greater magnitude during that year. And so oftentimes you do have years where you have meaningful drawdowns, but then you wind up the year with a relatively good gain. So again, this is event driven. We have a war in Iran, a bombing campaign, if you will. We have higher energy prices. We're going to talk about that. And there's some interesting dynamics at play. So let's dig into it. Here we have the average S&P 500 performance after an oil shock. Again, we are sitting here kind of in this boundary of Brent crude above $100 a barrel. And so this is a chart here from Deutsche Bank research that the farther you get after that oil shock, you tend to have a period in which you recover and then you get back to basically above where you are in terms of the index. So I think this is representative of the fact that it will take us a little while to get back, but I think it's also something that we should take stock of in terms of maybe establishing a basis for new opportunity. Here we have some expectations with regard to the conflict here. When do you expect a ceasefire to be reached between the U.S. and Iran? A large number of respondents expect April to be that month, and we're on the eve of April. That will happen next week. And as far as oil prices go, it seems like there's a building consensus here around maybe slightly more than 120 at its peak, particularly if there's any more, any worsening of the conflagration between the two, or actually I should say the three entities, because it's U.S. and Israel and perhaps some other involved parties as well against Iran. So in any case, that is the current level of expectation. As we continue our conversation about the oil markets, it's also a good idea to look at where spare capacity is. And here are some various incidences over time. And the available spare capacity has certainly not been constant through those instances. And you think about the ability to absorb the shock of this. It's a little easier if you have spare capacity, but in this case, we actually don't. And we've got 20% of the world's oil supply that's disrupted because of the closing of the Strait of Hormuz. But without that spare capacity, that's why we're seeing these prices increase. As we analyze the gyrations in the equity market, as we were just talking about, you've got a plot of crude prices versus S&P 500 that usually these things kind of coincide. I mean, I would say that there's not a perfect correlation by any stretch. In fact, it is positive to some degree, but when you get a price spike, you generally do see the equity market sell off. And as we saw last week, by and large, when you get a price spike, you're not dealing necessarily with a war, but maybe just kind of a conflict or bombing or whatnot. And oil prices jump and equity markets sell off for maybe 2, 3 weeks, and then they begin to come back. This one seems to have maybe a little bit more staying power, but again, honestly, if there was a cessation of hostilities in the next week, I mean, you could easily see the market go up 1,500 points, and it hinges on that kind of news flow right now. Here we have oil price shocks and their impact on the labor market. And it's interesting here is that we have a much more diversified economy than we did even 10 years ago, and certainly 25, 35 years ago. You can see here that the impacts of a oil price increase, and this is not really even a shock, but this is indicative of the fact that unemployment doesn't move nearly as much as it used to when we have an increase in oil prices, nor do we have as great a decline in non-farm payrolls. But having said that, there is some revisions out there in estimates with regard to the unemployment rate as we look into the latter part of 2026, and you can see some of those adverse case scenarios kind of pushing that number up around 4.7, 4.8. Whereas the current consensus is looking around 4.6. That's obviously up a couple of ticks or a couple of 2/10 of a full percentage point from where we are now. But I think that was always kind of in the cards, so to speak. Some interesting data out of Carlisle here. This is basically geopolitical fragmentation, and this is an index that they put together. You can see the world came together during the global financial crisis, and obviously during 9/11, there was a lot of rallying behind the cause against the insurgents and the terrorists, and that persisted for some time, and that's obviously turned the other way now with a very aggressive. Again, I'm not waxing political, but it is a fact that we are deglobalizing this world, and so you tend to have more geopolitical fragmentation there. But that's coming at a very interesting time that you've got market capitalizations that are moving higher, and you've got basically valuations that are moving higher. And you've got a dollar that, even though it's come off a little bit, you can see how it's moved up. The trade weighted dollar has moved up as well. And so it's a very interesting dynamic right now. Energy transition. I think this is really kind of important in this broader conversation of what's going on with energy prices. Is that, at least we have greatly diversified our economy away from fossil fuels. Now, they're still very, very important. And when you look at the aggregate here, we've gone from basically around 94 to around maybe 81%. But that's been a consistent decline. And the fact that what we do consume, we're producing much more of. And you could make a pretty decent argument that we're almost basically self-sufficient in that regard. And so you can see that this is arguing again. This is Carlisle that the change in fossil fuel, the share of primary consumption. You can see that during these phases where we've become more protective of our energy resources, meaning that we've experienced shocks, and we as a country have become more determined to have more domestic production, so to speak. And you can see that that's had a negative impact on the concentration of fossil fuels as a percent of our total consumption. Now we look at GDP estimates. This is the Atlanta Fed, a little bit different view. This is coming to us from Apollo. You can see that from where we started, Basically, about a month ago, we've gone from about 3.1 now to about right at 2.0% on our estimated uh, first quarter GDP estimate, which we will be getting here in just a few weeks. Interesting stat here. We've got basically a third of all U.S. government debt will mature and it'll have to be rolled over. As we know, we're deficit spending, so we're issuing more treasury. So not only do we need to roll this, but we're to refinance this, but we're also going to have to finance more. This is a big number when we talk about basically a third of all debt outstanding. And you're looking at basically the average interest rate on that that is ostensibly going to go higher. And we know rates have gone higher anyway, so that refinancing is going to be a little bit more expensive. And kind of as a follow-on to that, basically we've got essentially 20% of our total federal tax receipts that now go to debt service, and that's only going to go up from here. And so it's going to put pressure on government spending, which, as we know, is a key component into GDP. And if you have a crowding out of government spending due to the increase in burden from the national debt interest, then that's going to really curb discretionary spending, which is, of course, a relatively small sliver when you compare it against all the entitlement programs. Trade policy, interestingly enough here, trade policy uncertainty is increasing. That's not to say that trade policy is improving. It's just that at least people have a little bit better, expectation, if you will, on how things are going to play out, as opposed to last April when we had the tariff tantrum, and that had so much shock value to it. But I think we've learned to expect that you have big announcements and then it kind of softens up, and you don't necessarily get what was originally announced, and that's kind of settling in here. So on the other hand, here we have economic policy uncertainty, and that has certainly spiked. And we know that because we have, the risk of inflation, and we've got more input prices that are affected by oil, and we have greater economic uncertainty. We've got some consumer data we're going to look at. Sentiment's poor, but spending remains relatively high, and we know that's coming from the higher income cohorts. And but then there's other data that's not as conducive, and so the economic policy uncertainty is certainly accelerated. Yet we have not seen that in the credit spreads for fixed income. So, while this might be indicative, and you can see the relationship over time is not, it's not zero, right? I mean, it is a positive correlation. This deviation is rather unusual, but we haven't seen that kind of distress kind of priced into our fixed income markets yet. Now, as I've shown you, on a fairly consistent basis, we spend a lot of time with the regional Fed districts and their data. And so I usually will show you the index that comes out of that Fed district, as well as like shipments and orders. And but for the most part, those have been good. Now, what I haven't been showing you as much of, and this is a really nice composite here, is the prices paid. And this is meant to be a leading indicator. And so you have the Philadelphia Fed, New York Fed, and the Kansas City Fed, as well as the Dallas Fed. So you've got four of the major regional Federal Reserve districts, and you can see how this data really kind of lines up pretty well. And on top of that, this green line represents personal consumption expenditures, which is the proxy for inflation that the Fed uses. And you can see that there's probably some room for increased inflation, even though some of these figures have come off a little bit. But of course, they are elevated. And as you can see, the relationship here is that typically PCE will either follow or kind of lead almost concurrently. And so this gap here is just leaving some speculation that we're going to have higher prices. Here we have the services PMI. We've got basically input prices and then prices charged to try to recover those input prices. That's the services side, and you also have manufacturing for each of those two as well. And you can see here the PMI side that is moving a little bit higher. Now that PCE is going to be at the consumer level. This is at the production level. So we already see where some of these input costs are higher. Interesting chart here by Apollo. This is digging more into those goods prices. We look at the trade war, that was back at the tariff tantrum. And you've got basically imported goods that are affected by the tariffs. And unquestionably, those have gone up, and we know why. Domestic affected, we see those kind of moving in a slightly different direction, but then you've got domestic non-affected moving higher. So you've got prices of imported goods that are affected by tariffs, not surprisingly, have increased considerably. But you've also seen some embedded inflation in some of these other areas that touch the consumer in particular ways, particularly at the lower income cohorts. And you can see, even though we've got domestic affected tariffs that seem to be off their peak, because perhaps maybe we're getting closer to that point of anniversarying some of this, that is still pretty high in the aggregate. Here we have consumer sentiment. This has been weak and it's trending lower. You can see in both of these income cohorts, or each of these three income cohorts rather, that it's fairly weak. Now, the under 50,000 in that particular income level has been weak for some time, but you can see that the more wealthy income cohorts have decelerated in a fairly meaningful fashion. But of course, it is important to recognize what consumers do, not necessarily what they say they're going to do, because those can be two different things. And we can see here that financial conditions remain very conducive. We don't have really any kind of significant tightening of policy. So financial conditions are certainly conducive. Consumer spending here, we see that that's certainly in positive territory and moving higher. And again, so what consumers are doing in actuality is that they are spending and they're less impacted. They're taking advantage of those improved financial conditions, even though at the same time they say that their sentiment is poor. Got air travel. Again, no sign of stress in the mechanism here. Debit and credit card transactions remain higher. I mean, this is not, this is something that, again, if you're looking at it on its face in a microcosm, absent any other data, you'd say, listen, the consumer's in pretty good shape. Here we have the Kansas City Fed Composite Index. We have shown continuous improvement here, from a prolonged period of contraction in that district, but composite index looking good. And we've got new orders, both the current order book as well as the expected orders coming in looking better. So again, no sign of stress coming out of this district. Import prices, we know, have gone up. We were just taking a look at that. And we also see that import prices are up at the producer level. And in fact, this latest reading here for February on the monthly data came in at 1.3%. We were only expecting 0.5%. So year over year up 1.3. Again, it's not accelerated, but it is trending the wrong way. And interestingly enough, if we slide over here and we look at surveys from chief financial officers, they're reasonably optimistic about the U.S. economy. You can see that there have been moments where they've been, coming out of the global financial crisis, that they were much less optimistic. And And certainly they're optimistic about their own company as well. So again, no stress kind of indicated in these numbers, even if you have higher import prices for the companies that would be exposed to that thing. S&P 500, we see here that the earnings per share, we talked about this last week, just continue to move higher. In fact, you've got an acceleration in earnings growth expected this year, looking on the order of 20%, which, again, if it plays out, it's going to be nice, and it's going to provide a real support mechanism for equities. Now, here you've got the S&P 500 forward PE looking around 20 times right here. You can see the average far below that. So again, equities are not cheap, but again, they're not as expensive as they were. So one of the reasons I have come up with on why the equity market has been reasonably resilient, even though it is off and we've got some indices that are already in correction. One, we were coming off a fairly high peak. We'd had some really good performance in the market for a couple of years, and we didn't really have the kind of contraction that we're exhibiting now. So I think markets were ripe for a sell-off. But the other thing that we've got going for us is that amidst this weakened sentiment, and this is I show you this in a different form just about every week, but this is the American Association of Individual Investors sentiment figure, their bull bear spread. And so this indicates a very high degree of bearishness right now. But at the same time, we've got really, really strong equity fund flows into ETFs. So we've got a lot of liquidity entering the market, and the liquidity is really helping out valuations and really helping out, provide some buffering and some support for our stock markets. Now, we had been looking at the broader indices. I think it's also important to understand that the internals within those sectors, there have been companies that have been pretty weak within that. So, I mean, equity markets have held up reasonably well, even though we are down for the year. But you can see here that the 52-week drawdown on the part of index constituents, depending on what your stock selection is, you could have experienced a lot worse performance. So what we have is the sectors here and their max drawdowns, and this is the average stock within that. So there's certainly some laggard performers within the S&P 500 embedded in these particular sectors. On this slide, we have the duration of bull markets dating back to 1932. And, as we sit here at the end of the first calendar quarter of 2026 and reflect on the fact that 2023 to 2025 were good years for the stock market. And so we're now in the third year of, we passed the third year of this particular bull market. And of course, there's no guarantee it will continue, but the law of averages tells us that, basically, if you make it to 3 years in a bull market, that you're going to continue to go. And you can see that in most of these occurrences here. In fact, 9 out of 10 prior bull markets made it to 4. And, you'll also remember, too, that I've said many times, including earlier in this presentation, that there are oftentimes during the year where you have drawdowns of some measure. And in this case, we have a drawdown that is truly event driven, that in the absence of bombing Iran and higher energy prices, that who's to say, but the chances would be less that we'd be sitting here with a negative performance number for the year in the S&P 500. But there are many years where you get drawdowns within the year, but you end the year with a nice return. And so that could very well happen again this year. And as I've said, also that if hostilities were to end, or there to be an announcement that hostilities have ended over the next week or so, I mean, that announcement could drive the market higher by 1,500 points potentially. It has that much gravitas to it. But the law of averages is on our side to continue. Again, past is no prologue, but it is helpful for perspective's sake. So on this slide, we have some references to gold. We know gold had been a high flyer, but as we can see here, volatility of gold has really picked up as of late. And you can see gold prices having reset a pretty reasonable amount here in a relatively short period of time. A lot of that has to do with the fact that you've got the dollar that's moving a little bit higher, and you also have interest rates that are moving higher as well. Here we have the Treasury 2-year yield. We know that yields have gone up. There's a greater chance now of actually a rate hike to respond to inflation. And so the rate cuts that may have been expected as we entered this year are for the most part off the table for the time being. And you can see that basically rates all along the curve have moved higher, but they've moved a little bit more here on the shorter end of the curve. You can see that 2-year rates around 4.2%. And over here, we look at that spread between the 2 and the 10 years Treasury rates, and anything in this territory that's above 0 basis points tells us that there is a positive sloping curve. That means that 10-year yields are higher than 2-year yields, and that's what we want to see. That's a normal environment. It's indicative of a reasonable economy or reasonable economic condition. You can see that we had a negative or inverted yield curve for some time, and that gave us some worry that we're going to have a recession, and then that flipped and went positive and actually expanded to about 60, 70 basis points. And now we've given up some of that. So the yield curve still is positively sloped, but with short-term rates having risen more than long-term rates, we do see that steepening has abated somewhat. We'll kind of finish on a couple slides here. We've got private credit. Spent a lot of time at a conference in the Phoenix area last year talking to issuers and sponsors of private credit and private equity funds. And there really has been a tremendous sell-off. And this is like a fear with a capital F right now. And that you're going to have a situation where artificial intelligence is really going to hurt the business models of a lot of software firms. And so software as an average holding, as an average sector holding within these private credit funds is about 12 to 14 to 16%. And so the fear is you're going to have a lot of defaults. And so not only have you seen lower inflows into those private credit funds, but you've had a tremendous number of redemption requests. And some of those actually were from funds that had limited liquidity options, meaning that you could only withdraw like 5% of your investment every quarter. And so you've had redemptions that have been unfulfilled because of those types of restrictions. And so there's an awful lot of negativity in the market driven by the media, but I can say that the internals are much better than these statistics would imply. And in fact, it strikes me as a purchase opportunity for some of the outstanding funds that are trading at maybe a half of their net asset value. And here we have the slide on software, and you can see that for those loans that are software industry specific, that those prices have gone way down, and then they've held up pretty nicely outside of software. But again, you can see the magnitude of how some of these private credit funds have sold off, and recognizing that software represents really 15% of the total package when everything else is holding up very, very well. So again, this is one of those things where the market often can be very inefficient and kind of almost irrational in the short term, driven by fear. And then that usually those valuations typically work out over time. And I think this is a case where that is going to happen. Finally, we will end on this slide, which again, speaking to the whole private credit, private equity side of the equation. This is something, like I said, I spent a lot of time on last week. And frankly, I've spent a lot of time on over the last couple of years, but really beginning to drill down on the opportunity set with private companies. And, we see new business formation expanding, at the same time that we see the number of publicly traded companies go from like 7,500, 8,000. If you take this timeline even back to 1990, you were up at like 8,500, 9,000 companies, and you're below 4,000 publicly traded firms right now. So your opportunity set, if you're just investing in the public markets, has gone down quite a bit in a relatively short period of time. And as I said, meanwhile, the opportunity to invest in private entities has gone up. So your opportunity set is much more favorable on the private side now than it ever has been. And this is one of the reasons why I think it really behooves us as a company and you as an investor and a client and obviously a friend of the firm that we have these conversations about private investing and looking at those opportunities as we evolve portfolios over the coming years. That's all we have this week. Hope you have a great week, and we'll talk to you again soon.